Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Sean Brodrick is editor of Red Hot Global Resources and global resource hunter from Weiss Research. Check out Sean's blog at uncommonwisdomdaily.com. Hey, Sean, it's always good to have you back here on This Week in Money.
Thanks very much for having me on, Phil. It's always good to talk to you.
You are just back from the Vancouver Resource Investment Conference put on by our friends at CambridgeHouse.com. Eric Coffin and David Morgan were there, too. A lot of good folks will be there. We're going to be talking to them a little later on. Sean, how was the show? What was the mood out there? What were people talking about?
Well, people have been through some hard times, but I sense some general optimism underneath it. People know that these low prices can't last forever. And so I think that at least on the precious metal side, there was an admission that we may not be at the bottom yet, but we have to be close. And then one thing I was also speaking about was like natural gas, oil, stuff like that. Hopefully opening some people up to the fact that, you know what, you don't just have to invest in precious metals. There's plenty of money to be made in other resources, and I think that energy is one place with some extraordinary potential.
I love the title of your Sunday presentation, Welcome to Saudi America. Now, I'm just guessing here, but does this have something to do with energy?
Yes, it does. Just showing how much North America, not just the U.S., but also Canada, the increase in both oil and natural gas production is just extraordinary. And so this is giving us some real leverage, and one side effect is it's reinvigorating industrial production across North America, because we actually see companies moving from like Europe, where they pay a high price for natural gas, over to North America because of the low energy inputs over here.
Looking at what's going on with oil, it's breaking above $96 a barrel this week, a 4-month high. And so where are we going with oil? Are we heading for 100? Are we going to go over 100? Is it going to fall back?
I think we will test 100. What happens there, I don't know. And it's not being driven by supply. We have plenty of supply right now. What is driving it is optimism about China and its economy. We are seeing more good news on the Chinese economy. This is making everyone think that the emerging markets are going to gear up again, and so that's why we're seeing oil prices head higher. Now, of course, the cure for high prices is high prices. That will crimp demand somewhat. But as time goes on, people trade in their cars for more fuel-efficient cars, and like industries restructure, and so they use less energy. So higher oil prices have less impact as time goes on, but still, we will see that drag eventually.
We're talking to Sean Brodrick from uncommonwisdomdaily.com on This Week in Money. When we think about energy and investing in energy, we usually think of oil and gas company shares, but you have a great idea here to make money that does not involve drilling or pipelines. Tell us about this.
Well, actually, pipelines is one place where we make money, but yes, one thing we are doing is we are investing in the chemical companies which use natural gas as an input, and their profit margins are just widening, wider and wider. For example, the IYM, which is the U.S. fund that is the basic materials fund, that's 67% chemical company. So the IYM has been doing extraordinarily well.
Okay.
If you want to look at individual companies, you can look at, say, Dow Chemical, ones like that. They're all talking about how they're restructuring to make more money off these low energy inputs. Another one would be any company that uses natural gas as an input, like, say, a steel manufacturer, and of course fertilizer makers. They can make tons of money that way too.
Well, there's lots of talk about pipelines and transporting oil via pipelines. One of the things that is kind of below the radar for a lot of folks is moving oil by rail, and some of the opportunities that you're covering there.
Oh, you're giving away my whole presentation.
Sorry.
Yeah, that's okay. No, I'm just kidding. Yes, there are lots of opportunities there. In fact, one chart I showed how much rail traffic of like moving oil by rail has gone up year over year. It's an explosive move, and it is more expensive than using a pipeline, but it takes a long time to build a pipeline, and it doesn't take that much effort to build a new rail car. And so that's how you're seeing a lot of it move, because there's plenty of oil that's trapped in Canada. It can't get out. There just there isn't enough space on the pipelines to actually move it. So rail is one answer. And we should continue to see them do well for the next couple of years because you can't build those pipelines fast enough.
How can we make some money here? I mean, one of the largest companies here, BNSF, is owned by Warren Buffett, of all people. So there are actually a few public railroad companies available out there.
Oh, there's more than a few.
Yeah.
One you might look at, the U.S. symbol is RAIL, rail, and they build the actual cars which travel on the railroad. And you can look at railroads, just wait for a pullback. No one wants to chase anything. Then again, if you're looking at a trend that should last for the next 2 years, you don't want to be too selective either. So I think people just have to wait for those pullbacks. We have economic scares all the time. For example, the next thing coming up is the sequester. And what will the Republicans do? And are we actually going to have a functioning government? I'm sure some people will get shaken out of the trees and stuff like that. So that might be a good time to pick some stocks up.
Sean Brodrick, our guest here on This Week in Money. Let's talk about oil itself and oil production. Here's an interesting stat I just found a couple of days ago. U.S. oil production growing at the fastest pace ever last year. More than 50 million barrels of oil in storage in Cushing.
Yeah, and more than that, oil production in the U.S. is now growing at the fastest pace since the middle of the 19th century. It's just extraordinary.
Wow.
Now, another group that's a real winner from all this is the refiners, right? Because they have cheap inputs here compared to, say, a refiner over in Europe. So they can take the oil from here, turn it into refined products, and then ship it overseas. That's what we're seeing a lot of now. But that's probably a trend that's going to continue. So again, on a pullback, you might want to pick up a refiner or two.
Energy stocks moving, and you better keep an eye on things. Tell us how Red Hot Global Resources works.
Oh, well, let's see. Red Hot Global Resources is my small cap service, or it's mostly small caps. Okay. Let's just say smaller cap. And what it does is I look for select opportunities around the world, mainly in the Western Hemisphere, though also Australia, stuff like that, and looking for good opportunities that we can really get in before they built themselves up and make a good amount of money. Now, Global Resource Hunter, that's larger stocks, and we try to catch the bigger trends there, but we're playing plenty of energy and food stocks and all the other stuff in there that will make money off of what I'm calling the new fuel revolution, which is cheap natural gas. We will probably have it for at least another 2 or 3 or 4 years. I mean, even if the price of natural gas doubled, which would then, by the way, bring on more production, it would still be cheap to what we are seeing over in Europe and especially over in Asia. So this is a big trend. This is one you can make money on. I think some companies will certainly do better than others. Some will be hurt. If your company is an oil producer and it's in Canada and it can't get that oil out of the middle of Canada, that is a problematic situation.
No kidding.
And that's recently why we saw That's recently why we saw the oil up in Canada trade at a discount of about $41 to the U.S. benchmark, which is already trading at a discount to the European benchmark. So that's a problem for some companies, but there will be many winners, and I think there's lots of good ways to play this. One thing that I would like to point out to everybody is cheap energy is really bullish for the economy as a whole. Now, we are seeing oil prices go up, but that's not the only energy that's used. And those parts of the economy that use natural gas will probably have cheap energy for quite some time to come. And so that's bullish for a lot of things outside of the whole energy arena.
Seems, again, here's natural gas, something that is below most folks' radar because the prices have been down for so long. Are there opportunities in natural gas, and how can we take advantage of those?
Yes, but again, it's those stocks that I spoke about earlier, like the chemical companies, the fertilizer manufacturers. Those are the ones with the cheap natural gas inputs. One thing, though, that you can buy is a good pipeline company, especially if it's moving natural gas out of the shale gas areas, which we're just seeing explosive growth in production there, and moving that to, say, the Gulf Coast, because those pipeline companies are getting more and more volume. Therefore, they're making more and more money. And we keep hearing things from, say, like ExxonMobil last year famously said, we're losing our shirts on the price of natural gas. And yet natural gas production keeps going up and up and up. Why is that? because natural gas is produced as a byproduct of oil, and so therefore, since the price of oil is quite attractive, they want to produce more oil, so they're producing more natural gas even though they're not drilling for it directly. So these are some things to keep in mind. I think we should see natural gas, it'll be volatile, but still the price should remain under pressure for quite some time.
Sean Brodrick from Uncommon Wisdom Daily, our guest here on This Week in Money. And Star Wars fans everywhere are going to like this. You're calling natural gas the Admiral Akbar of investments.
Yeah, because we keep hearing from people how it's a trap, how which of course was Admiral Akbar's famous line in Return of the Jedi, so they say natural gas prices can't last this low, and I'm not saying they'll last this low, but they'll stay low enough that it's a boost for the economy, for industries of all types, and especially for those that use cheap natural gas inputs. So, yeah, the price may go up, but probably not a lot. And so I don't believe that it's a trap. I believe that it's a big trend you can invest in, and that's the way we're playing it, and it's been working out for us so far anyway.
Tough if you're trading natural gas. Prices have fallen more than 20% since late November. Wow.
Now, of course, if you're trading natural gas, you'd be using either the UNG fund or the other one, which I believe is GAZ. I don't actually think that's the best way to do it. You'd want to use natural gas futures, which means you need a future account and you need advice from someone who knows what they're doing with futures. I mean, it's not an easy market to trade. Mm-hmm. Be careful if you decide to do that. And whatever you do, don't buy it just because some guy on the radio likes it. Do your own due diligence. And but I think that if people look into natural gas, look at how that being cheap for quite some time could be a big boom for all kinds of other companies. I think that's something that they might want to consider making some changes in their own portfolio.
Sean Brodrick is editor of Red Hot Global Resources and Crisis Profit Hunter. Check out Sean's blog at uncommonwisdomdaily.com. And you can find Sean on Twitter at Sean Brodrick.
Yes.
Great place to be, and we appreciate you talking to us.
I always appreciate you calling, and give a big shout out to all my friends in Canada. I know they're pretty cold right now, so I'm sending them lots of warm thoughts from Florida.
This Week in Money is archived online at talkdigitalnetwork.com.
Eric Coffin is editor and publisher of the Hard Rock Analyst newsletter. He is online at hraadvisory.com. It's always good to have him back on This Week Money. Eric, welcome back.
Thanks for having me.
You were at the Vancouver Resource Investment Conference last weekend. We've been talking to folks about how it's been going. A lot of great people there. You were there along with David Morgan, Sean Brodrick, John Embry, Rick Rule. You've been going to these shows now for quite a long while. How did it go this year?
It was a little bit on the slow side at first, which is what everyone expected, obviously. Given the way the market's been. I was actually surprised how many people were there on the Monday. Normally you expect Mondays to be significantly slower than Sunday, but there were actually quite a large number of brokers showed up after the markets closed, which tells me you've got a bunch of guys, not to put too fine a point on it, looking for something to do, looking for product. Okay.
Now, a lot of folks at the show, you're saying, are pretty negative, and you've always been a contrarian guy, so I guess that makes you positive on what's going on out there. What's the outlook that you see? How does it differ from the kind of mood of a lot of folks out there?
Well, I was hoping to see the negativity that I did see there. I mean, and it's not really surprising given what the market's done since really March 2011, but you know, in my experience with these juniors, you really kind of have to have that washout. You really need people to be pretty negative and to run out of sellers for things to turn around. And I think we're pretty close to that point. I think we probably still need a couple of positive indicators or catalysts to get things going. But to me, it feels like it's bumping along the bottom. And if we can get a couple of catalysts, I think things will probably start improving. I'm not expecting anything dramatic.
What kind of catalysts, Eric, are we looking for? What kind of things do you think will happen?
I mean, a big move in metal prices would help. I'm not sure that I expect that personally. I'm not that positive about the gold price. I mean, based on my underlying thesis that the U.S. economy is probably going to surprise on the upside, that generally means you're not going to get much stronger gold prices, but it partially depends on all the political nonsense in Washington. That's going to be driving things in the short run. The other thing that always helps the resource sector, of course, is discoveries. It wasn't a good financing year last year at all. So there's a relatively limited number of guys that have got the budgets and projects interesting enough to drive that part of the catalyst side. So we'll have to see whether one of the relatively few companies doing serious programs in the next 3 months actually pulls a rabbit out of a hat.
We're talking to Eric Coffin here on This Week in Money. We're talking about political nonsense. We've got some news on that this week. America, of course, avoided the fiscal cliff earlier. They just simply moved the cliff forward. Now the debt ceiling is taking place, and economic showdown with the president. They've put that off until late May. That's got to affect the mood out there, right?
Yeah, I think really that, I thought that was a positive development in the sense that really it's the debt ceiling is what really scares the market, and rightly so. I mean, that's the one that can really do damage. We still have to see what kind of deal, if any, they come up to in terms of the budget, but giving themselves some breathing space to at least make a deal certainly seems to have calmed the major markets down some. I don't know. It really comes down to who's got leverage, so it's a little bit hard to say what the final deal is going to look like. It's going to impact what happens in the U.S. this year, because depending on how large the cuts are and what the mix of cuts and tax increases are, that's, it does have the potential to shave a 1% or 1.5% off whatever growth rate the U.S. manages to attain. But I think just getting that done would make people feel a lot better. Everyone's just so sick of it.
Eric, why does this remind you of the situation in Canada in the late 80s? Tell us what was happening then for folks who are maybe not old enough to remember what was going on then.
It was a similar situation in that, you basically had all the spending envelopes or entitlement programs, as they call them in the States, were growing at a pretty rapid clip. A lot of new spending initiatives had been added. Taxes simply weren't keeping up with them, and the deficit was getting wider and wider and wider, particularly coming out of the 90-91 recession, which was a very severe one in Canada. And Canada was in a tougher situation in the sense that, unlike the U.S., we weren't the darling of the bond market, and we had bond yields starting to climb fairly rapidly. The market was telling us, we're simply not going to keep selling you debt at these rates unless you get your house in order. And that forced both sides of the parliament to make some decisions. I mean, the Conservatives, who you would think of as being the low tax party, brought in the GST, and of course got sent to the woodshed for 20 years because of it. And then the Liberals came in after them, which everyone normally thinks of as a spending party, and Paul Martin basically clamped down on the budget and cut expenditures year after year for 4 or 5 years. It wasn't a lot of fun. I wouldn't say it was easy, but it wasn't the end of the world. And I tend to find it quite frustrating when I look at the situation in Washington, because, to be honest, I don't really get the sense that the politicians on either side of the House and the Congress down there have got the stones to just get this done. I mean, it's just getting to the point where it's annoying everyone. Just get it done.
Eric Coffin from HRAadvisory.com, our guest here on This Week in Money. We're talking about the debt ceiling. We're talking about gold. That has obviously benefited from all this talk. Here's a headline from CNN Money this morning, Eric. Gold bugs dancing on the debt ceiling, and they're trying to figure out why gold prices are back near $1,700.
I think that's part of it, and what you've got going on this year too is you've got competing. Gold always gets affected because whenever you're talking about gold prices, you're always talking gold prices in a specific currency. Most of us think in terms of U.S. dollars, so you're always going to be looking at impacts of different currencies against the dollar. Right now, you've got the Japanese doing their damnedest to push the yen down and doing a fairly good job at it. The euros hasn't shown a huge amount of strength. It's shown a little bit lately since our calming down there. So I think your big determinant is the U.S. dollar going to see a lot of softness because the politicians just play things a little bit too close and get too close to the debt ceiling and scare guys out of the bond market. So far they haven't, but that potential is there. I think if we were to have a big run in the gold price this year, it would be because the politicians in Washington just got stupid.
Eric, a lot of folks forget that I think since 1960 they've raised the debt ceiling almost 70 times. Is that true?
Yeah, it's a farce.
Yeah.
I mean, the whole thing is just a farce. It's ridiculous. They've done it actually over 80 times, and most of those increases were done by Republican administrations, and it was really just a housekeeping thing.
Okay.
I mean, it's one of those things that they put in place so the politicians can say there's a debt ceiling, but until 2 years ago, really, every time they got close to it, they just raised it. It was completely meaningless.
So let's assume that's going to continue ad infinitum. What's that going to do to gold?
Well, I mean, they're going to keep printing U.S. dollars. I mean, the big scare that the gold market got was reading the Fed minutes from December, the U.S. Federal Reserve meeting in December, and some of the Fed governors were talking about turning QE3 off sooner than people thought they would. That might happen, although I would remind people that really what Bernanke is using as a yardstick isn't. It's not Washington. It's not the deficit. It's the unemployment rate. And to his mind, what decides whether he keeps the printing presses going is whether according to him, the unemployment rate's about 6.5%. I think it's likely to take most of the year, and it might take longer to get it below that level. So I don't think we have to worry about the printing presses being turned off. And even if that comes to pass, even with some kind of a deal on the budget, the U.S. is going to be printing money for a long time to come. Even the most rosy scenarios doesn't show them getting into a surplus in Washington for years and years and years.
A lot of folks wondering why, with all this going on, gold just seems unable to break out of that $1,700 box.
I think there is some, it comes down to what's the least bad alternative when you're looking at currencies against the gold price. And I mean, the Japanese are very actively pushing their currency down. It's the third largest traded currency. Second biggest is the euro. They've had their own problems, although I think if Europe actually gets its act together even a little bit and generates a little bit of strength in the euro, that's going to help the gold price, because gold tends to move with the euro, not against it. And I think the assumption on the part of some people, including me, frankly, that the U.S. might do a little better than people think economically, that's given the dollar, strength would be too strong a word, but it's kept it stable. And I think if Washington manages to get through the ceiling and the budget issue without too much stupidity and too much pain, I'm assuming the gold price isn't actually going to go up a lot this year. My working assumption is we might see 5%, no more than that, unless they really do something stupid.
Folks from Morgan Stanley, they have good news. They are still bullish on gold, and they're saying this week the demand for gold is low, and they figure that's going to keep a lid on prices. Does that make sense to you?
Yeah, it does. I mean, I think people are. I think right now you've got to see some improvement in places like India that are big physical buyers. I mean, the gold market's always been a very strange and wondrous place, because you've got it being traded every day in amounts, orders of magnitude larger than the actual production. One thing I would remind people, though, when it comes to medium and long term, is that the relative dearth of new, really large discoveries and the slowdown in spending plans by a lot of the world's mining companies means that there's not really a lot in the pipeline. So it doesn't take a lot of demand growth in the gold market over the next 5 years to keep prices pretty stable and maybe even moving upwards, because after a little bit of a bump that we're having right now, I don't see a lot of increase in gold production in the next little while. There just isn't that much stuff in the pipeline.
We've got some mining news here. IAMGOLD, Eric, losing almost 20% of its value this week after announcing that they're going to reduce exploration activity in Mali. That's a no-brainer there, right?
Yeah, I mean, unfortunately, it's yet another North African country that seems to be having problems with the Muslim. I'm not sure whether Muslims are a minority or a majority or what in Mali these days, but the whole country's turned into a little bit of a tinderbox. I'm watching to see how much impact that has on surrounding countries. I know there has been some influx of people into Ghana and into Burkina Faso, just trying to get away from all this stuff. But things aren't looking terribly stable, and of course that area is one of the big growth areas for production, or at least that's what everybody was assuming until a month ago.
Here's a guy with an interesting idea to totally get away. There's a company at the conference, Planetary Resources, based out of Seattle. Chris Lewicki is the president and chief engineer, says they see an opportunity, get this, mining asteroids.
It's one of those things that anybody who's read science fiction, which I've done for 40 years, has certainly heard of before. A lot of asteroids are light metal, but there's certainly some heavier metal ones, and it's an idea that probably makes some sense in terms of being theoretically possible. Whether it's going to make sense in the near term in terms of being economically possible is another question. I have a bit of trouble getting my head around these guys being able to produce anything for a price remotely like what you can do it on Earth these days.
Yeah, it would be hard to get a handle on the numbers involved, would it not? I mean, wow.
Yeah. Well, it's just your CapEx is enormous. I mean, I love the fact they're doing it. I mean, as somebody who did grow up reading science fiction, I'm all for it. It's just like, I don't know whether it's going to make any money, but I think it's a great idea.
Eric, a lot of folks at the show probably asking the question we've been asking ourselves for the last couple of years. Hey, if gold and silver are doing so great, why aren't the stocks doing well? Why have gold stocks continued to underperform?
You know, the thing with gold production stocks, if you go back to the start of this bull market, if you will, and we're sort of in the 12th, 13th year of it now, you go back early to the bull market, you would find that the market was willing to actually pay much higher multiple for gold mining stocks. And there was a simple reason for that, and that's that a lot of people buying the gold stocks back then weren't really buying them for the PE. They were buying them for the ounces in the ground. They were buying them for basically for leverage on the gold price. And although people still do that, it's a lot tougher to make the argument at $1,600 than it was at $300.
Yeah.
You know, at $300, lots of people were paying, like 50, 60, 70 multiples on gold stocks were actually pretty common because people weren't buying it for the earnings. They were buying it for the leverage. But with gold, it's $1,600. I don't think there's that many people around that really honestly think gold's going to $6,000 or $8,000 or $10,000. So they're going to have to basically earn their keep the way most of the other stocks in the market do, and that's with earnings growth. And I think part of the slowdown that you're seeing that's driving gold bugs nuts is simply these stocks normalizing to something a bit closer to what the rest of the market gives you. I just don't think I think the days of 50 or 60 multiples for gold stocks are over.
Eric Coffin is editor and publisher of the Hard Rock Analyst newsletter. He's online at hraadvisory.com. Hey, Eric, always good to talk to you. Thanks for this.
Thanks very much. Thanks for having me.
This Week in Money is archived online at talkdigitalnetwork.com.
David Morgan is our go-to guy on silver, and you can find him at silver-investor.com. That's the home of the Morgan Report. David's coming to us today from Spokane, Washington, the heart of Morgan country. David, it's good to have you back on This Week in Money.
Phil, it's great to be with you. Thank you.
You are just back from the Vancouver Resource Investment Conference. I want to apologize in advance for the rain and fog. That was pretty awful, wasn't it?
It was a bit cold and didn't see any sun, but it was a good conference.
That's the way it's generally like in January here in Vancouver. But let's ignore the weather outside and talk about what was going on inside. How did the conference go this year? What'd you think?
Well, I would say it was warm to warming, meaning it wasn't one of the hottest conferences I've been to. But I think the overall mood was cautiously optimistic or better than that. I talked to one of the marketing guys that said he had a better 2 days than he has had in the last 6 months. So let me rephrase that slightly. He did a lot of business with companies that were willing to spend money on marketing. So obviously there's companies out there, and more than one, that are saying, you know what, things are getting brighter, they're getting better. We're willing to spend some money here. So I concur. I think that the bottom is pretty much in or forming or at the end of the bottoming process or the consolidation. And I'm looking for a good year for the precious metals in 2013, not an exceptional year.
Interesting combination of exhibitors and speakers, and you were one of the speakers there. You're always at these things, and we appreciate you coming to them and appreciate bumping into these things. Your speech this time around, why now is the best time to invest in precious metals? Give us just a thumbnail sketch of what you were talking about.
Well, Jeffrey Christian, who's pretty famous, and he's more established probably than I, but he does good work in my view. And he said a long time ago that 90% of the move comes in the last 10% of the time. And knowing the silver market, as well as I do, and certainly I'm not a know-it-all, but looking at it, I thought, that's about right, and I never really did the arithmetic because it's a very small math problem, but I actually did that. And I pointed out that 87.5% of the move came the last 7% of the time. So that means that we're going to probably see a great big move in silver. And this happens in all markets. Silver happens to be extreme, but happened in the tech wreck, happened in the bond market, happened in the housing bubble, happened in Japanese stocks. Mm-hmm. All markets get very overvalued, and it gets into this kind of manic phase where it just keeps going up and up and up and up, and people say, it can't go any higher, and it keeps going up and up and up. Silver did that in 1979 and 1980. I think it's going to do it again. In fact, I think it's going to do it again in such a manner that it's going to make the 1980 high look like a warm-up.
Okay.
Time will tell if I'm right or not. So I wanted to point that out to everybody, that the biggest move lies ahead. It's going to be more treacherous, it's going to be more difficult, and it's going to be faster moving. But nonetheless, it is ahead of us. So that was the main thrust of what I spoke about at the conference.
Boy, you wouldn't have to look much farther than this for the reason for what's going on in precious metals. This is from the latest Scotia Makata Metal Matters Monthly. And I'll quote here, the financial system is drowning in debt. There seems to be no end in sight to ongoing massive deficits. Confidence in the financial system and in the fiat paper that facilitates it will remain low.
You know, it's funny. I mean, I have to comment, but I mean, that's like something I wrote about
years
ago. 2003 or something.
Yeah.
Now somebody, like Scotia Makata is printing it, and this is, pretty much mainstream. I mean, they are a metals dealer, but they're also a bank, well-known, well-established, stalwart of a bank, really. And here they are, and, I was radical when I was making those statements in the early 2000s, but now it's a matter of fact. And it does portend, I believe, strongly that we're going to see more and more move into the metals as time marches on. And this is going to be, I think, the turnaround year, meaning that a lot of newer people are going to come into this market and buy with confidence and hold. So I think we're going to see, again, higher metals prices this year.
David Morgan, our guest here on This Week in Money. Here's an interesting stat we were talking about earlier. Holdings in silver ETFs standing at more than 600 million ounces as we're talking. Now, compare this to late 2008, 3-4 short years ago. It's doubled in that time space.
Again, I think this just shows that the strength in the silver market for real physical silver as an investment continues to grow, regardless of what you hear in the mainstream financial press, and regardless of the negatives. I mean, this is a fact that cannot be disputed. Of course, silver moves in and out of these ETFs, but the overall trend has been more in than out. And again, the tightness in the silver supply, Phil, is very, very great. You wouldn't know it based on the price, and especially the price pattern, meaning the charts over the last several months. Nonetheless, the fact remains that the market is much tighter than it appears if you were just going to look at a chart.
So what's driving silver prices? Is it investment demand or industrial demand?
Well, it's both. I mean, silver doesn't care what the demand is from. It's demand, but it's really investment demand because it's always at the margin. If there was no investment demand for gold, who knows what gold would be, because really there isn't an industrial demand for gold per se. Yes, there's a very, very slight amount. Basically, all demand for gold is investment demand, and silver has the luxury of having investment demand, and on top of that, a substantial industrial demand, and for most cases, it's price inelastic, as John Embry pointed out during his lecture at the Vancouver Resource Show.
What about volume? What's happening with trading volumes? Are they still low? What's going on there?
Good question. It's one of the key things I look at in the technical side. And the volumes have been low, average to low. They're average or lowish in the average. So that does not excite me. When I see the metals moving up or down, I want to see what the volume is. And when they're average or slightly lower than average, which is where we've been, it doesn't show a lot of strength. So even though the market's very tight, as I said, there isn't a whole lot of strength in the futures market. Now, of course, the physical market's a different animal, and the volumes there appear to be above average. But those are very difficult to get a handle on. The futures contracts, I can call my broker and get a number. I can compare it to other numbers, and I know what the paper traders are doing. On the physical side, it's more of a survey that I do by literally picking up the phone, calling the largest wholesalers in the country, some of the largest retailers in the country, and say, how's business? And taking kind of a survey and getting from that. Having done that recently, the physical demand side is still very robust relative to what, again, you would think by the price alone.
Well, you sure have to take these forecasts with a grain of salt. Here, as you're talking, I'm looking at the latest forecast from Morgan Stanley. They say demand for gold is unusually low. They say that's going to keep a lid on prices. Does that make sense?
Well, they're right if the demand is really, really low, or there's going to be a lot of sellback, or whatever side they're pushing. But you really have to be objective, and I'm biased. I admit that I try to stay objective when it comes to the numbers, but I don't buy into what they're saying. I don't think the demand side is that low. And there's so many reasons why, as Scotia pointed out in the article that you just read, that there's so many reasons to get back into the metals if you've left it, or to add if you're in it, or to become a new person or entity or trust or pension fund or hedge fund or what have you into the precious metals. So there's a lot more going on for buying them than there is for selling them.
Here's another opinion, David, from Morgan Stanley about silver. They say silver could outperform gold on a price basis as it has what they're calling a cheaper entry point.
Well, that's true, and silver has exhibited that in the last bull market. I mean, once gold got to a certain level, no one knows the exact number, but the idea is very clear. Once it got to 500 or 600, it was unaffordable to many, many people. And so they looked at the next best thing, maybe in their view, not in mine, but in theirs, and said, I can't afford gold, I'll buy silver. That will happen again, and no one knows the price point. I'm forecasting somewhere around the $2,000 level. Okay. Once gold gets up there and starts making news headlines again, see a lot of people go, geez, 2,000, I don't make that in a week, or I don't make that in 2 weeks. But silver, it's only 65 or 75 or whatever it is at that time. I can afford that. So you'll see a lot of people that want to get in the precious metals, and they will choose silver over gold for a variety of reasons.
Somebody I was talking to last week said, used this phrase that I hate, silver, the poor man's gold.
Well, I, can shut off most of these negative connotations. There's so many fill around silver, junk bags, what do we call a scrap supply, and all the stuff that permeates the silver market. What I always laugh about when it's the poor man's gold is if you go back to the beginning when I was suffering as far as making a living, but who was buying? Warren Buffett, billionaire. George Soros, billionaire. Bill Gates, billionaire. So if those are the poor men that are buying silver, so be it. But the billionaires are buying the bottom. They weren't buying gold, by the way. They were buying silver. I mean, they might have bought a little gold, but the large investments, at least that were publicly disclosed, was in the silver market. I mean, Buffett bought 129.7 million ounces of silver, silver itself, silver bars. He moved it to London, and that's basically the basis for the start of the silver ETF. So the SLV. So, that's the truth of the matter. So, again, I kind of just bite my tongue when someone calls it the poor man's gold.
I can see why they call it the Rodney Dangerfield of precious metals.
Exactly.
But it's finally starting to get some respect.
Well, it is, and it will. And that's, one of the things I haven't talked about in a long time is, why I became such a silver bug. And the reason was I was kind of just a gold bug during the first run, most of the run in the precious metals during my earlier days. And after the thing peaked and came down, I asked a couple really important questions. I said, why were the hunts in silver? What was it that intrigued them about the silver market over gold? Of course, part of it, was a lot of things were in it. But basically, based on that study is when I decided to say, the dynamics for silver actually are superior to gold for so many different reasons.
David Morgan, our guest here on This Week in Money. You can find him online at silver-investor.com. Let's take a look at what happened this week in gold and silver. Gold seems to be in consolidation mode, Dave, poised for a 2% loss this week. Prices falling for 3 straight sessions.
Yeah, I mean, I do look at it daily. I do look at it daily. And it's kind of wearing us out. I mean, I coined the phrase on one of the other financial channels that, this market will wear you out or scare you out. Very typical of a long-term secular bull market. It's not much we can do about it. Knowing that maybe will help you, keep your conviction. And I do, again, think that we're probably near the end of that. I do think that we're going to see a pretty good first quarter in the metals. And over the year, I think we'll be higher significantly by the end of 2013. And there's so many black swans out there, Phil. I could end up being very, very conservative on this. I mean, something could happen. Who knows where? I won't even venture a guess. There's so many possibilities out there where the metals just catch fire because of some event in the banking system, the brokerage system, the derivatives that are out there, a country, a mining accident, shipment failure. I mean, there's tons of things out there that could cause a real ignition, you might say, in the precious metals. And there's a lot more of those that are possible than there are, a meteorite of pure silver hitting the ocean, and all of a sudden there's a huge abundance of silver supply.
Or an asteroid.
Or an asteroid. There we go.
Now, gold seems unable to break through this $1,700, this psychological $1,700 mark. If it does, what happens then?
Well, it goes to the next level. I mean, there's overhead supply if you trade commodities, and any commodity, even gold, and people think, well, the market's manipulated, and I agree for the most part, but it's still... They behave as very closely, whether they're manipulated or not, based on price patterns. And so you have other levels that you have to break through. Once gold gets above the $1,900 level, which is basically its current high, then it will be on its way again. And it's not that difficult, but most people are too concerned with how difficult it is to do technical analysis or whatever. It's really not that hard. And it's not a perfect science, but it's a good art. I've learned it many, many years ago, and I apply it with my own methodology that I found to be much, much better at making significant entry and exit points than any other methodology. It's one that is not taught very often, but it's been tested, and it has a greater ability to make profit than any other method out there. So, why not use what works?
Dave, silver down this week. It's moving down by about 1.5%, still up by around 3% year to date.
Typical, really. I mean, again, I think that we're just going to have to work off some of this overhead supply and get through it. And it'll take some more time, but again, I don't think we're that far away. I think after this first quarter is over, if we can get silver above 35, and I think that'll be the case, I'm looking for above 40 for the year. And it may just get a couple flurries where we actually start to test the $48 level. I don't know if we'll get through that and stay there. But again, these black swans that are flying around, you never know. There could be some unforeseen anomaly out there in the silver market, gold market, or both, or something in the banking system again that all of a sudden ignites these markets and they don't look back. That's the reason you really want to be early and you really want to buy a quiet market. You really want to buy when you feel discouraged or the market's discouraged and sentiment is low and, geez, when are these metals going to move? And the mining shares are so decimated and on and on. That's the indicator of a bottom. And you're supposed to buy low and sell high. So I'm telling you, folks, this is really closer to a bottom than a top. This is a time you really should be looking into the metals.
Here's an interesting stat on the XAU. It's down almost 3% this week. It's lowest level since last August. Now, there's some despair for you.
It is. I called the bottom on the indexes. It was May of last year. August was another bottom, as you just mentioned. We're above that low. I think that low will hold, but it is discouraging, especially for people in the shares, such as myself. I'm in the metal, of course. I think everyone knows that. But, these shares have really been tough. Mm-hmm. And, we're looking at our portfolio. Our suggested one, which is pretty close to how I personally invest. And we've done better than a lot of these other companies, but when you're saying you've lost less, that's hardly consolidation. But for somebody that's down 80% on a lot of their stocks, we're only down, 12, 15 on some of them, it might make you feel better. I don't know. It's just been a tough year and a half, 2 years, and there's no excuses. I mean, it's just the way these bull markets manifest. And again, this is a time to really not be discouraged, even though that's how you feel, because it's the bottoms that are opportunities.
You can find David Morgan at silver-investor.com. It's the home of the Morgan Report. Hey, David, it's good to talk to you again. Thank you for your time.
Phil, always a pleasure. Thank you.
Thanks to our guests, Sean Brodrick, Eric Coffin, and David Morgan. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.